Hello and welcome back to Simple Money Podcast, Canada's own personal finance podcast presented in short and informative episodes. I'm your host, Matthew Seawick, also known as the Friendly Financial Coach. So for today's episode, we're going to cover the GameStop Saga and pick it apart to see what's really happening behind the curtain. And as you probably already know, this is a pretty hot topic right now, and I actually received quite a few requests to really decipher what's going on. It's actually so hot that Netflix and MGM have already penned deals to make movies about the situation. So, to first understand what's going on, we really need to look at the main stock at the center of the debate, GameStop. Other stocks have been involved, but this is the main one receiving the most amount of attention. GameStop is the world's largest retailer of video games, consumer electronics, and interconnected products in the world with approximately over 5,500 retail locations. Now, the company started in Dallas, Texas in 1984 as Babbage's and quickly took advantage of selling the hot product at the time. You got it, Atari 2600, the 8-bit wonder that revolutionized home gaming by putting an arcade in everyone's home. So further successes for the company were found with Nintendos, Sagas, and so on and so on. And over the next few decades, there was quite a bit of drama that went on behind the scenes. They went through a Chapter 11 bankruptcy, there were a couple acquisitions, and more, until February 12th, 2002, when GameStop officially had their first public offering of shares at $18 USD per share. Now, shortly after this, they bought the retailer Electronic Boutique, aka EB Games, which is the name that would be most familiar to Canadians. You've probably seen this in almost every single mall that you've gone to. And their business was all fine and dandy until 2016. And at this juncture, competition from online game retailers like the Microsoft and PlayStation Store really started to dent sales. This drop in business can also be seen in their stock price. Now, recent lockdowns due to COVID-19 further affected their sales by temporarily shuttering their retail locations. During 2020, the share price hit low points of about $3 to $5. And at this point, the share was also starting to catch the attention of a few retail investors who considered this to be a really undervalued stock that also had a lot of potential. And now this is really where the recent GameStop drama begins. Many large financial companies took short positions on GameStop. It was reported by Business Insider that at one point, 140% of all publicly traded shares were being shorted. So there's actually more shorts than there were shares being publicly traded. And this is the part of the episode where we have to take a brief step back and look at what short positions even are, because they can be a little bit complicated to wrap your head around. But the easiest way to look at them is that they're essentially the opposite of a regular trade where you buy shares and then hope that the price goes up in the future. So how a short position works is that a company borrows shares from another company and then sells them before they actually own them. Then at a later date, they will need to buy back those shares to replace the shares that they borrowed. And the hope here is that they can sell them at a price that is higher than they are worth at the date when they have to buy the shares back. Basically, what they're doing is they're making a negative bet that the share price will decrease after they've made the sale. And during this period of time, the company that lent their shares to the short sellers will also be charging them interest. They will also require that the short seller keeps a deposit of some amount to partially guarantee the borrowed shares. This is essentially a way to protect the companies that lent out the shares in case the short seller is not able to pay them back. So historically, short sellers have not really been held in the highest regards in the financial world, essentially because they're betting against the market. They really want to see it go down. And they will often try to publicly discredit companies and really attack the ones that are vulnerable. Now, the short position is also one that's considered to be of unlimited risk. And this is because, in theory, a share price can rise to any amount before they have a chance to buy back those shares to replace the ones that they've already sold. And the term that the financial world uses when a stock price is increasing past the short sale price is called a short squeeze. The squeeze also builds on itself when short sellers buy the shares to close their positions earlier on, which then pushes prices back up because it increases the demand. Now, as the short sellers were circling GameStop, a colorful subreddit called Wall Street Bets gained support of retail investors to band around GameStop, causing the price to absolutely skyrocket. To show the impact, the stock closed 2020, so the ending of last year, at a price of around $18.84. And at its highest point, hit $483 during intraday trading. This is a 2,363% increase. And a casual stroll through the subreddit shows that the main reasons for this push was to really stick it to Wall Street and less to make a profit. And in the famous words, it was Main Street versus Wall Street. And this move did hit the hearts of many large investment firms. We don't know how much exactly was lost by short sellers, but some reports peg it to be around $7 billion, and has caused several Wall Street firms to have some serious financial problems, even requiring a bailout from one of their peers. Now, the next move was made by the trading firms. Robinhood and TD Ameritrade halted the purchase of GameStop shares, which then sent the price spiraling downwards. Now, the official reason why this move was made was to protect retail investors from a very volatile stock, but credible claims are made that they were attempting to protect the hedge funds, especially since there's a direct relationship between some of these companies. Robinhood generated a large amount of their revenue from Citadel securities. And this growing craziness brought the ire of regulators and government officials in the United States and worldwide. The White House, Congress, and security regulators were all involved. Many Canadian regulators are also looking into this situation, and Wealthsimple even put warnings on volatile investments. And now, as of recording this episode, the share price for GameStop is hovering around $60, and the posts on Reddit are full of people relishing in their losses. These investors knew that they probably would lose money, and many of them seem unfazed, even those that have lost six figures. And there's a reason why this subreddit's called Wall Street Bets, right? They completely understand that this is basically a form of gambling. And many of these people are still holding strong with diamond hands in their desire to spite Wall Street. And a lot of great stories have come out of this subreddit so far, including a fellow that sold some of his GameStop shares to buy Nintendo Switches and games from GameStop to donate to a children's hospital. Others bought billboard space to champion their cause. Someone paid for advertising in Times Square. And someone even paid to have planes fly around with banners mocking Wall Street. It's uncertain what will happen next, but it's likely that the interest in GameStop will slowly dissipate and the price will decrease. The price of the shares are clearly overpriced, and many financial professionals put its true value at around $10 to $25. The impact will also radiate into other areas too. Some good, some bad. New regulatory discussions are now ongoing, and all levels of US government are looking into the practices of Wall Street and whether any changes need to be made. Later this month, one of Robinhood's founders will also need to testify in front of Congress. Janet Yellen, the new Treasury Secretary, is also under intense scrutiny. She had been paid hundreds of thousands of dollars by Citadel for speaking engagements. Beyond regulatory changes, the force of retail investors has shown that they can be a formidable and also unpredictable force, a situation that will definitely arise in the future. Other components of the financial system may also be affected by the behavior. Passive index funds, like ETFs, that include GameStop and other affected shares, have in some cases had to readjust their holdings to adjust for the growing market share of these stocks. And Wall Street firms would also have to make up for their losses, which may require them to liquidate certain investment holdings, which then could affect the prices of those securities. And there's already in the works 2 films from Netflix and MGM about this whole saga. And that's about what we know now. It's been a crazy ride so far, and without a doubt, there's going to be more. So thanks again for listening to Simple Money Podcast. If you have any questions, you can send me an email directly at info@ffcoach.ca. If you have any episode recommendations, also feel free to send them my way. Take care. Talk to you soon.